My name is Ian Walsh. Today we're with Masters of the Market, the series that everybody likes, joined by, everybody saw George's interviews most likely earlier in the week, but this is the big one, the one that everybody sees. So I had to pull some strings. Actually, Sam, who you guys will be contacting, pulled some strings for me to get in front of George and to take a peek into the big banking world, into the world that most of us don't see. At Rittenhouse Capital Advisors, George is the CEO, a man that's been in the banking world for your entire professional career?
34 years.
34 years. So you've seen it all, including some of the toughest times in this entire country, in this market. You were in the banking industry. I mean, it's not front lines, but in the banking world, it was a big, all eyes were on the banking world, right, in 2008. So yeah, give us some background to you, George. Maybe start with 2000, what you saw from 2000 to 2008. What happened in 2008? Like, how did that affect you? What did you see? So talk about that.
Well, in that period, I was with Credit Suisse versus Boston, who was a securitized lender on the commercial side.
All right.
Everybody knows that the securitized residential market had a lot to do with, the bubble bursting and the crash that followed that. So I was on the commercial side of that, and things were great. 2000 up to 2007 was a great run. Business got better year after year, and ultimately, money was too easy on the residential side. Money was certainly very easy on the commercial side. That created a bubble, and ultimately, that brought upon the crash in 2008, which shut down the banking industry for a good 3 to 4 years.
Yeah, money got tough. So then what? Then what do? You got the cards fall. Everybody was affected. In some way, everybody was affected. So you rally the troops. You figure out what you're going to do next. And so, what was the play after that? Post 2008, how did you shift?
At that point, I was with J.P. Morgan Chase on the balance sheet lending platform. Got some lending activity in for a very brief time before everything crashed. And at that point, the bank took a few months to assess damage, so to speak, and what's the game plan from here. And J.P. Morgan was very honest with themselves and probably one of the first banks to make the decision, hey, we're just going to sell notes, non-performing loans, we're going to sell REO, and we're going to get out of this thing, through this thing, out of this thing as quickly as possible.
So that's what those tapes, they call them tapes back then, right?
Exactly.
That was it.
Yep.
Offloading these $500 million in tapes, they used to call them. I remember that. That's what you're talking about, right? Okay. And that was their exit strategy. And then, so they exited. J.P. Morgan Chase and all banks at that point made a similar move. And then you guys, when did Rittenhouse Capital Advisors start? And then, how'd that go? How was the progression there?
Rittenhouse Capital, we're basically in our 4th year.
Okay.
3.5 years in, and that game we started in 2013.
Okay.
When the economy was recovering and the debt market coming back, and we felt that there was real opportunity to not just do debt on the multifamily side, like there was at Chase, but that we could do all sorts of debt, as mentioned before, development deals, acquisition, renovation loans, and all asset types, retail, office, industrial, healthcare. So we felt that given the times in the economy and the opportunities there, that we could cast a much wider net and really, for those involved with the company, do very well.
Okay, so you made a move towards it, and we have a lot of friends in common, and so I know the circles that you run in are very accomplished people, and obviously they add a lot of value to you. You add a lot of value to them. Makes a lot of sense. So, but now we are where we are today. Everybody's got their opinion as to where the market's going. Everybody's going to adjust their business accordingly. Some people think we have 10 years to go. Some people think we have 6 months to go. Doesn't really matter, I don't think, to what. So, but you see that your business, as you've done over your entire career, you've had to adapt at different times. So, what are you thinking over the next 5 years? Like, what do you expect in your business? How will it grow? How do you see the market transitioning? That kind of stuff.
That's a tough question to answer in a short period of time. But
sure.
I personally think that we have, and speaking about the Philadelphia region, maybe the greater Northeast as well, but
sure.
I think we've got another 3 to 5 years to run. in a positive way.
Mm-hmm.
I think that given where the economy is, there's more room to grow there. I think that interest rates will not increase at kind of the dramatic level that people fear.
Right, it would freeze the economy, right? You couldn't do that.
Right, and of course real estate. So I'm actually bullish on that, and I think that there's so much money out there buying real estate, both at the lower level as well as the institutional level, and everywhere in between that. That will keep prices up. I think it will keep interest rates relatively tame. And as I said, hopefully we're in for another good 3 to 5 year run.
Yeah, and then I think about that too. The interest rates is most people don't really think much about interest rates, but when you back out what an interest rate really ends up becoming is like the money that the Fed might have now, say just 0% for the sake of the conversation. They lend it to the banks have to put it out at a spread. Well, the scare is always that money now that's 3%, if that goes to 6% too fast, that same property you could buy, the average person just can't afford what they could afford at 3%. I mean, it's very basic, right?
Yep.
In your industry, you guys have balloons, 5-year, 10-year balloons. There's always, hey, we have I don't even know what the balloon notes are now. Let's say 4 or 5%, and then 5 years of balloons, are we going up to 7, 8%? Like, it changes all the cash flow, right? But I think everybody's pretty aware that would be a traumatic experience for the economy, right? So I'm hoping, just like you are, that if you're going to raise them, which I think there's a healthy number to be at. I don't think where we are now is sustainable. It makes capital so cheap, so easy. But I would hope that the Fed raises it at a rate that's controlled and get back up into the residential 6% eventually, right? Because you do it too fast, everything freezes up, nobody can afford anything, and that would just be totally counterproductive in 2008's reason we dumped all the money in to begin with, right? So, do you guys do a lot of, is it a lot of balloon financing? Is that how that works? Like 5-year balloons, and typically
most commercial deals and most multifamily deals, meaning anything that would be 5 units or more, 9 times out of 10 will be a 5, 7, or 10-year maturity. Okay. Most of the deals we do are 10-year maturities.
Okay, and then and that's typically, are they normally fixed interest? Is that how that, or is that change? Is there arms? I don't know.
Typically, the option is you can fix for 5 years and then reset for another 5. Okay. Or you can fix for 7 years, reset for another 3, or just take a straight 10-year fixed rate.
So if there'll be a lot of different kinds of people watching this, and some of these people will be looking for financing for sure. Because I get these calls. When you get everybody that has called me in the past and said, Ian, can you do this $20 million deal? And I'm just like, I'm sorry, it's not in our wheelhouse. Well, here's your wheelhouse. So all those people that are going to be watching this are going to say, okay, do I still have a live deal? So ideally, if somebody could call you tomorrow with some kinds of deals, or how should they approach you and how should they present you? Because I know what I like to see from a hard money lending perspective, and I don't need nearly as much polish and presentation as you guys would probably want. If I'm coming to you for $20 million, you better not give me a handwritten note and say this is how much it costs. So what are some things that on a basic level, what kind of spreadsheets would you want to see? How do you like it presented? As opposed to somebody just slapping something together.
Sure. Well, I think you'd be surprised because it's a pretty simple process, whether it's $1 million deal or even a $50 million deal. The best place to start is just to get a copy of the current rent roll. Who are the tenants in the building? What kind of rent are they paying?
Okay.
How long do the leases run? And then optimally, you want to get at least 2 or 3 years of the income and expense statements.
Okay.
And that's enough for us to take that first step, put it into our model, and do an analysis as to what is this building worth, what can we potentially finance it for, etc.
So it's really, I'm overcomplicating it. So you guys, for anybody watching this, that's great, right? So you don't have to be intimidated to come. You say, if the numbers make sense, this is what I need. That's really good. Really good, because I would be, quite frankly, I didn't know. Anybody watch this? I didn't know. If I came to you and said I want to do this big deal, I would assume I would need to walk in here with a binder full of. But you're saying, give me these basic numbers if they're right, and we can start from there. It's a starting point.
And that at that point we can give them a 1 or 2 page quote.
Okay.
And they can determine whether or not we like the deal, we don't like the deal.
That's super simple, man.
And go from there.
I mean, I know there's a lot more as you get the due diligence, but you can screen a deal like that.
We can.
Okay, that's fantastic. So for anybody that was like me watching this that was overcomplicated in their head, I don't know any different. I guess when people call me for a hard money loan or something, they're probably maybe thinking the same stuff. But I'm like, you send me 3 numbers, and I'll tell you instantly whether there's something going on here or if it's not. So Anybody watching this, George, what would you kind of leave somebody with if they wanted to approach you, or if you had something that you kind of, somebody's maybe looking at their first deal they're doing, it's a big deal, or they have somebody they know that has like a 100-unit apartment complex they want you to take a look at. What's some advice maybe you give to people trying to get into that world?
Well, I mean, the first thing I would say is we're happy to talk to anybody about any deal. We do typically set our minimum debt level at $1 million, but we have a handful of deals that we've done for clients that are less than that. And generally, if it's somebody that we see has a portfolio of business and could be a developing relationship,
Okay.
it's easy to justify working on those smaller deals. In terms of somebody looking to grow into the larger space and buy bigger buildings or grow their portfolio, there's a couple ways to do that. Obviously, consolidate your existing portfolio and parlay that into a smaller number of assets, or partner up with some folks that have the same goals. And last but not least, there's a lot of money out there that wants to just invest passively.
That's right.
From an equity standpoint, and you could leverage off of that to help kind of build a portfolio and obtain larger assets.
That sounds good, man. So what we're going to do for everybody here today, the contact information for your firm will be at the bottom of the email that everybody will see. So it actually won't be in the video. You'll see it right under the video. You guys know who I am. Obviously, you're probably getting the email from my name, so I don't need to state it. But George, I really appreciate your time. I truly do, not on off camera. I appreciate it. And yeah, if you guys have deals, some big deals, 1 million plus, don't be afraid to approach them. They're very approachable people, and they run a tight ship. So thanks, man.
Excellent.
All right, you got it.